Good morning, everyone, and welcome to today's discussion on healthcare taxes in New York, hosted by the Empire Center. As Director of Public Affairs, I'm thrilled to have you all with us this morning. Think New York is our monthly webinar series that we do to shed light on some of the fundamental issues in New York that often go unnoticed. These issues are deeply ingrained in New York State governance and often can fly beneath the radar. Before I get started, I want to encourage everyone today to actively participate by putting your questions in the chat. Bill, our Senior Fellow of Health Policy, will be addressing your questions at the end of the presentation, so don't hesitate to engage with us throughout, and we will make sure that we get to those questions at the end. But let me first provide a brief introduction of who the Empire Center is for those of you who don't know. At the Empire Center, we're dedicated to promoting transparency, accountability, and fiscal responsibility in government. Our research spans various policy areas, including tax and budget, healthcare, labor, energy, and education, all aimed at providing citizens with the information that they need to make informed decisions and to really hold elected officials accountable. Today, we're here to discuss healthcare taxes in New York. Bill Hammond will be discussing that with us momentarily. Bill brings almost 3 decades of experience in journalism and a deep understanding to the healthcare industry to bear. Before joining the Empire Center in 2016, Bill spent almost 3 decades in journalism. Most recently, he served on the New York Daily News from 2005 to 2015. Before that, he wrote for the New York Sun, the Daily Gazette of Schenectady, the Post Star of Glen Falls, and his work appeared in Politico, The Post, City and State Albany's Time Unions, and many others. A graduate of Albany High School and Harvard University, Hammond lives in Saratoga Springs. So as I mentioned earlier, as we proceed with the presentation, remember to drop your questions in the chat, and Bill will address them at the end. Otherwise, Bill, I will turn it over to you. You can take it away.
Thank you, Kyle. Good morning, everyone. Thanks for joining us this morning. We have a lot of material to cover, so I guess I'll jump right in. We're going to be talking about taxing healthcare in New York State. New Yorkers already in the status quo, we pay about $6.5 billion annually in state-imposed taxes on health insurance. The biggest part of that is $5.2 billion in surcharges levied through something called the Healthcare Reform Act, often called HICRA. And that works out to an average of about $400 for each premium paying customer. And again, that's under the status quo. The newly enacted budget included another, I'm calling it a $4 billion tax because that's the number that was thrown around. And it would apply to managed care organizations, which is really just another word for health plans, at least as defined in the law. But the law is very vague about how this tax is going to work, where it's going to come from, how it's going to be spent. Because of that vagueness, it's a little hard to know how it's going to play out. I think the stated goal is that this is about exploiting the federal funding system. Unlocking additional aid is the phrase that's being used. But it might also add to the high cost of coverage in New York State, or it could do a little bit of both, depending on how it plays out over the long term. Regardless of the details, regardless of whether it's drawing down more aid or just increasing taxes, it's expected to drive an increase in spending on Medicaid, and that will potentially cause a fiscal cliff in about 3 years. This is why healthcare taxes are a significant issue in New York State. We have some of the very highest health premiums in the country. As of 2022, the average cost of employer-sponsored single coverage was just under $9,000. And you can see, they're growing at the national level too, but the New Yorks are growing faster, and we're getting farther and farther above the national average, which is just under $7,600. So there's that gap is about $1,300, and The current taxes on healthcare, the HICRA taxes alone, account for about a third of that gap. Um, so this new MCO tax, it didn't come out of nowhere. It's a variation on a practice that's been widely used almost since the beginning of Medicaid, sometimes called provider taxes, sometimes called health-related taxes. This is a way that states they use these taxes to take advantage of Medicaid's shared financing system. I think most of you are going to be familiar with that, but the basics are that Medicaid's a safety net health plan for the poor and uninsured, and it's been designed from the beginning to be a shared program where the state and federal government split the cost of that coverage, and it's been done on a matching basis. So the state, New York State, for example, puts up half the cost, and the federal government matches that with another half of the cost. It's actually a little bit more than 50% federal aid at this point, but I'm going to sort of pretend that it's 50% because it's easier to follow the math. The average across the country is 60% federal participation, and it can go as high as 80 or even a little higher than that. So that these taxes are a way of siphoning away the federal match without the states actually putting up any real money of their own, which is kind of undermining the purpose of the program. Federal officials are aware of these tactics, obviously, and they've tried to kind of tamp down on them with various regulations and laws. But something California did really exposed a big new loophole. This is the healthcare provider taxes, and the way they work in Medicaid can be really head spinning to follow. I know I find it head spinning, even as I've studied it very closely, and as I try to explain it to other people, it just never fails to be confusing. These illustrations are my potentially lame attempt to make it easier to understand. So in this case, the health industry is the state in this illustration has imposed a tax of $100 on the health industry, kind of generically. The state then takes that $100 and pumps it into its Medicaid system, and the federal government matches that with another $100. And as a result of that transaction, the state breaks even. It's a wash. The health industry gains $100, and the federal government has put up all of that money, all of that net gain for the health industry. Now these taxes, Medicaid does not flow even-handedly to all parts of the healthcare industry, and so in some cases, these taxes create winners and losers, where those parts of the health industry that do the most business with Medicaid, they get the most benefit from this Medicaid increase. They may be, and they come out ahead compared to the tax that they pay. Maybe some other members of the industry don't come out ahead, but states often structure these transactions in a way that delivers additional Medicaid to the health industry so that they make up for whatever the tax cost was. And those things are called hold harmless provisions that states often work into these deals. And this makes it all politically palatable for the healthcare industry. You can go to the industry, which in New York, as in many other states, is very influential politically, and you can go to them and say, listen, we're putting a tax on you, but you and your members are going to ultimately benefit in the end. And that's why these taxes often kind of are a palatable alternative to other sources of revenue, because you have a cooperating taxpayer. If the tax kind of zeroes in on Medicaid providers, there's another way that these can be structured, and that's where, okay, so the Medicaid providers pay a $100 tax. The state only puts part of that money back into Medicaid. They draw down the federal match, and in this scenario, it's the state that comes out ahead, $50. The Medicaid providers break even, and again, it's the federal government that's putting up the money. In this scenario, the state is essentially taxing the federal government. It's 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 gaming the Medicaid system to draw down $50 from the federal government, which is intended to be used for healthcare, but which actually ends up going to the bottom line of the state. And the state potentially can use that money for healthcare, but also it could use it for anything else under this scenario. Now, the feds have watched these tactics develop and flourish and different variations on them. Oh, by the way, I should point out that you can have hybrid versions where the state and the healthcare industry kind of split the proceeds. The states, the feds, on and off over the years, have tried to constrain this practice, and in particular, they passed a law in 1991. This has never been really a partisan issue. It's not so much left versus right or Democrats versus Republicans. It's state officials, the interests of states versus the interests of the federal government. That's the main dividing line. And so this crackdown law in 1991 was sponsored by a liberal Democrat from California, Henry Waxman, and it was signed into law by a Republican president, George H.W. Bush. It set down these principles that said that if you're going to use a tax on healthcare to finance Medicaid, it should be broad-based, meaning it should apply across a large group of taxpayers, not some niche set of providers, and it should be uniform so that all similarly placed taxpayers pay at the same rate. And they also they told states not to do these hold harmless provisions where they engineered a Medicaid payback that definitively reimbursed the cost of the tax. This law also kind of had a safe harbor provision for small amounts of tax. But as a lot of laws do, it delegated the details to the Centers for Medicaid and Medicare Medicaid Services, and that was a complicated process. It also told CMS, like, states should come to you and get waivers. When they do a health tax, you need to give them a waiver. Between the process of writing regulations and reviewing waivers, this dragged on for years. So this is where the beginning of the Healthcare Reform Act came in. It was passed in 1996. It was sponsored by then Governor George Pataki. He was a fiscally conservative Republican, and his goal was not primarily to raise revenue or impose taxes. It was to abolish the state regulation of hospital prices, this really big, complicated system called NIFRM. At the time, the evidence had come out that this NIFRM system was backfiring. It was actually causing hospital costs to be higher than they were in other states, and so there was broad support in Albany for abolishing it. But the hospital industry was concerned about these things that they called public goods, and that was things that they were doing that were subsidized by NIFRM, and they were worried would not be subsidized in a negotiated set of hospital prices. The public goods in particular were charity care, the free care that hospitals were providing to uninsured people, but also the training of physicians, which is known as graduate medical education. And to finance those public goods, they established these two surcharges. One was a kind of sales tax on hospitals and clinic care, and the other was a per person covered lives assessment, a per person tax on each enrolled insurance customer. The patient services surcharge was earmarked for charity care, and the covered lives assessment was earmarked for physician training. And so these were relatively small surcharges. They were levied on the health industry because the health industry was the one that was supposedly going to get the benefit of negotiating hospital prices and getting a better deal. And they were dedicated. The revenue was mostly dedicated to these narrow purposes of the public goods. But like it's probably not a spoiler to tell you that this did not continue the way it was originally intended. It has evolved considerably. Those surcharges were originally thought of by many of the people who were involved in this to be temporary, but they never went away. In fact, the legislature went back in and extended them. It's become almost routine now. I've lost track of how many times they've been extended. The most recent extension happened last year, and it was a 3-year extension to the end of the 2026 fiscal year. These surcharges also, in the process of extending these surcharges, the legislature repeatedly increased the revenue that they were raising. And so that patient services surcharge, for example, started out at 8.18%. It is now 9.63%. The combined revenues of the surcharges have more than tripled from 1.3 billion to 5.7 billion, and they're currently the state's fourth largest source of revenue. So income taxes is the highest, sales taxes comes after that. Those two are really the dominant sources of revenue. Excuse me. And but then after that, it's corporate taxes and then HICRA. So every other tax the state collects, gas, alcohol, marijuana, the lottery, everything is smaller than the Healthcare Reform Act surcharges. They also no longer are earmarked the way they used to be. They are most of the money just goes into financing Medicaid. In my view, this is a very dysfunctional way to operate to run health policy. I mean, the basic reason is that they undermine the goal of universal coverage. So the reason we need a safety net health plan is that commercial coverage it can be hard to afford, and here you're financing the safety net by making commercial coverage even more unaffordable. Another big downside is that they're kind of hidden from public view. Unlike a sales tax, which turns up on your receipt, or the income tax, which you have to file a return every year, most New Yorkers don't even know HICRA taxes exist. They certainly don't have any idea how much they're paying. That's because it's directly paid by the insurer. It's passed on in the form of premiums that are paid by and large by your employer, and you just don't see that paperwork. Another thing to think about is that we go to great lengths with the income tax to make it progressive so that it charges a higher rate based on higher income. There's nothing like that with the HICRA tax. It's attached to your insurance, and insurance is kind of a per person charge rather than income based. This can be especially painful, these taxes, for the uninsured, because they don't have an insurance company to pay them to pay on their behalf. I talked to a farmer from upstate New York years ago, who he was out driving his tractor, working his fields, and he got hit by a tree branch. Tree branch fell on him and cut his face pretty badly, and he didn't have health insurance, and so he gritted his teeth, went to the emergency room. The emergency room handed him a bill. He was ready to pay it, and the cost of stitching up his face was $1,900, $1,900. But then at the bottom of the bill it said NYS surcharge, $180, and that was HICRA. He called up and he's like, "Well, this, I can't afford health insurance. I can barely afford this emergency room bill. Why is the state taxing me on this?" And I said, "Well, that's how HICRA works." It's also like among many other taxes, it's a hindrance to job creation because employers, when they're thinking about how many jobs they can afford to create, they have to calculate in not just the salary but also the cost of benefits, and the cost of benefits are increased by this tax. And then a final weirdness about this system is that it doesn't charge the same rate across all regions for the covered lives assessment, one of those two surcharges. This is what it looks like. These are the official rates as posted on the health department. So in New York City, an insurance plan is supposed to be $189 per person that they enroll, whereas an insurance plan in Utica Watertown is only needs to pay $10 per person. That's a 1,900% difference. This goes back to the origins of this tax, which was supposed to be about subsidizing teaching hospitals, and there are a lot more teaching hospitals in New York City than in any other part of the state. But again, that's not what this tax does anymore. It's just a general source of revenue, and for whatever reason, the state has never bothered to go back and smooth this out. So this brings us to an interesting bit of history, which I only recently learned. HICRA was in part a provider tax because the patient services surcharge was collected not just on commercial insurance, but also on Medicaid. So the state was taxing hospital services provided on behalf of Medicaid recipients. That meant that the state and the federal government were paying the tax. The state's portion of it was a wash, and the federal aid was the net benefit. And so the state needed a waiver because of that 1991 law. When it passed the HICRA, it needed a waiver from CMS. And CMS was dragging its feet on waivers, not just for HICRA, but for a few other smaller provider taxes that New York was levying at the time. And it was starting to get panicked. It was collecting so much revenue from these taxes. It was worried that if it didn't get a waiver, it was going to have to pay the money back, and that was going to cause a real budget crunch. So Governor Pataki decided to go over the heads of the CMS and go straight to his political mentor, Al D'Amato, then the U.S. Senator. He was the majority party senator at that time. And he drafted legislation which basically just said all of New York's provider taxes are deemed to have a waiver from CMS. And again, this wasn't a partisan issue. Daniel Patrick Moynihan, a Democrat, was also on board. And they were able to get it inserted into this big budget bill called the Balanced Budget Act of 1997. And I'm seeing now I misspelled that. And so, it was time to pop the champagne corks. HICRA was safe. All the other provider taxes were safe. But then President Clinton came in with a line item veto. And this was a brand new authority that he had. It had been a priority for Newt Gingrich and his contract with America. Some of the more seasoned members of the audience will remember this. This was a multi-plank platform that the House Republicans had campaigned on. And this was one of the planks that they actually followed through on, and they granted a line item veto. And this was the first time Clinton was using that authority. And he used it for a few provisions of the Balanced Budget Act, and one of them was the D'Amato Amendment. And so now the HICRA taxes were in jeopardy again. Well, then enter Mayor Giuliani. He had been elected a few years before, and he filed suit on behalf of the New York City hospital system, which stood to lose money if the waiver was not granted, if the D'Amato Amendment was not upheld. And the Supreme Court, the case was argued all the way to the Supreme Court, and ultimately the court ruled in favor of the city's suit and other similar suits brought by other affected organizations, and found that the line item veto was unconstitutional. They weren't ruling on the merits of whether the state should have a waiver or not. They were just saying that the line item veto as used by the president was not constitutional. And as a result, all of New York's provider taxes in place as of June 1997, including HICRA, are indefinitely exempted from any CMS requirements regarding provider taxes. And I think that might be one reason why the covered lives assessment is still so crazy, because state officials are nervous about tinkering with it too much because they might lose their exemption if it might be deemed as a new tax. Okay, so fast forward to 2023 and shift your focus to the left coast. California had an MCO tax for 20 years, but in 2023, it had a budget crunch, and one of its strategies for balancing its budget was to quintuple the gross amount of their MCO tax to $8.3 billion per year. And their goal was to extract $4.4 billion in additional Medicaid funding, which they were just going to use to balance their budget. So it was a straight up, attempt to extract money from the federal government to balance their budget. And the way they structured it seemed to fly in the face of all of the CMS standards. So, for example, it exempts members of health plans below 100,000 and above 330,000. Well, in California, that's the vast majority of all insured people. And it charged a dramatically different rate for health plan members who were on Medicaid, $182 per month versus just a token amount of $1.75 for everyone else. This is going back to my diagram. This is what it was going to look like. It was going to collect $8.3 billion in revenue almost entirely from the Medicaid part of the MCO business. It was going to put less than half of that back into Medicaid. That was going to draw down a federal match. And that what the state put in and what the federal match put in would reimburse the Medicaid MCOs. They would be allegedly would be happy. The commercial clients were going to pay very little, and the state was going to come out $4.4 billion ahead. All of that coming from the state. In effect, California was taxing the federal government and therefore taxing the whole country to the tune of $4.4 billion. Now, from the point of view of a state official who's focused on just focused on their own budget crisis, this seems like a windfall, money out of the sky. But from the point of view of taxpayers, they have to pay federal taxes too. And you may think, well, if we can maximize our federal aid, we're getting ahead of the other states. But of course, all the other states can do the same thing, and many of them probably will. They've already done some version of it, and now that this new opportunity has been shown by California, that more states might jump on the bandwagon, including New York. So why did CMS granted a temporary waiver? Why would CMS give a waiver to this if it so obviously flies in the face of their law? Well, that's because CMS has this statistical test that they apply to judge whether a tax is redistributive or not. It involves college level statistics. I have not even seen the actual formula they use, let alone I wonder if I would understand it. But suffice it to say that California understood it, and they reverse engineered all of the details, the weird details of their law, the amount that they charge to Medicaid versus non-Medicaid clients, the tiers of enrollees that they chose to exempt or not exempt. When those details were plugged into the CMS formula, it came back with a green light. It came back with a ruling that this tax was redistributive, even though it plainly was not. And because it passed this technical test, CMS felt like they had to grant a waiver, but they made it only for 3 years. I mean, it's technically like 3 years and 9 months or something, because it's retroactive to April 23. But they wrote in a letter to CMS, look, this does not appear consistent with the spirit of the law. We understand now that our rules aren't sufficient. We're going to be tightening them, probably going to be rethinking that whole formula system. And they also warned California in this letter that you should not expect to get this same deal again in 2026. So this is kind of a two-sided coin. On the one hand, they got kind of dressed down and warned by CMS that they didn't like this deal and they're not going to let them do it again. But on the other hand, California's getting the benefit of $4 billion a year for 3 years. And over in Albany, they saw this and they thought, ooh, this is an opportunity. The idea of following California's lead was first floated in the Assembly, Senate, one House bills in mid-March. The proposal, the Senate version of it said we're going to try to seek approximately $4 billion in additional federal financial participation per year for 3 years, very consciously sort of drawing on what happened in California. Hochul, her response was, well, let's see what our odds are of getting CMS approval. She went to CMS. She didn't really get any satisfaction from what's been reported. She did not get a clear answer from CMS, but she and the legislature decided to go ahead, and they put in this kind of placeholder tax without giving any of the specifics. This is virtually the entire language of how they describe the tax. At the end, they kind of listed the health plans that would be covered, and it's basically all health plans. So the three main things that they said is that the health commissioner should apply for a waiver of the broad-based and uniformity requirements. They should issue regulations surrounding the provider tax, and they should impose the provider tax, subject to approval by CMS. Well, let's think about this. I've never seen anything quite like it before. It's a significant tax where all of the details are delegated to the DOH commissioner in conjunction with CMS. It doesn't explain that they want to do what California did, although everybody seems to understand that's what's going on. It doesn't give any dollar amount that they are trying to raise, $4 billion or any other amount. It doesn't say who's going to be taxed precisely or how much. It doesn't give the rates or the exemptions. And it doesn't say we want to do this without hurting commercial customers. And finally, it doesn't have an expiration date. So everybody understands that this windfall is likely to run out at some point, probably in 2026. At best, they could expect only a few years of this revenue, but the MCO tax, as it's written now, would continue indefinitely. And then they had a separate section that talked about how the money would be spent. And that was also kind of vague. It said you could use it to spend more on Medicaid, but you could also use it for capital, or you could just use it to reimburse the general fund for Medicaid expenses. And that's kind of budget language for saying you can use the money for anything else in the budget. So this diagram has a lot of question marks on it. We don't know exactly which part of the MCO industry is going to be taxed or how much. We don't know how much revenue is going to be raised. We don't know how much the state's expenses are going to be to reimburse the MCOs. We don't know how much the federal match is going to be. This is kind of one scenario that the state might follow, where they collect $4 billion from the MCOs. They pump that back in the form of their share of Medicaid. The feds match it. It wouldn't be exactly these numbers because the federal match is a little higher than 50%. But in rough terms, the state would break even. The Medicaid system would gain $4 billion with the expectation that the MCOs would pass it along to providers. And the federal government would put up the entire cost. So what's supposed to be a shared system of Medicaid financing would really be this portion of Medicaid would be the bill would be entirely footed by the federal government. Another scenario would be if we run this the way California did, where the net benefit of the MCO tax goes to the state, but then the state puts that amount, it organizes a $4 billion net benefit and then puts that amount into Medicaid, and that draws down another $4 billion match. So for a net gain to the Medicaid system of $8 billion, again, entirely paid for by the federal government. This is speculation on my part, again, because the law doesn't give the details. Regardless of what those details are, I think there's a real danger here of a fiscal cliff. And that's because we know that all the expectations is that at best, even if CMS does allow New York to do this, it's going to be short term. And the talk in Albany is about using it to increase provider rates for hospitals and nursing homes and other providers, that the rates that are paid by Medicaid. And those are typically, they're not typically short term. And so when the windfall runs out, the state would face a choice between either canceling those rate increases or finding another source of revenue. And meanwhile, there would be this MCO tax, which is already on the books. And they might be tempted to reconfigure that MCO tax to continue providing the necessary revenue, but it would include a contribution from the commercial sector, and therefore a higher tax on health insurance generally, and on the employers and consumers who have to pay the premiums. And this would be, it would also be contributing to higher spending on Medicaid. So that's my presentation. I'm happy to, if it looks like we do have some time for questions, and I'm happy to answer the ones that I can.